Cool. Let's go for it. All right. So I look forward to this conversation. As a realtor here in the Bay Area, I get these questions a lot because it is certainly impacting people's ability to one decide which areas they may want to get home insurance, and things certainly have changed throughout the years. And so today I have two experts with us, and I'm glad we have two different kind of views of it. We have Aaron at Farmers, and then we have Richard at Goosehead. So Richard at Goosehead is more of an insurance broker, and I'll let you guys do a little bit of an intro. And Aaron will be at one of the bigger carriers here. He'll be able to share a little bit about the experience of how things have progressed over time. Are things changing back? But let's start off with some intros. Aaron, can you please tell us a little bit about yourself? How long have you been with Farmers? And then we'll go with Richard and we'll start asking some questions.
Yeah, I've been with Farmers for about 10 years now. And Farmers is a very unique company where we're captive agents, where we're allowed to sell Farmers products. However, our contract also allows us to go outside of Farmers, where we have a brokerage called Craft Lake, so we can shop with a few select carriers that we have access to whenever Farmers doesn't have an appetite for that type of risk, or they're not eligible because of underwriting guidelines or whatnot.
Got it. Okay, great. Thank you for the intro. Richard, tell us a little bit about you, your history in the insurance world, and go from there.
My name is Richard Holmes. I own a brokerage called Goosehead Insurance. We're a franchise that specializes in mostly homeowners insurance. We also do a little bit of auto and umbrella, but our bread and butter is homeowners insurance. The model is based off of just finding the right fit for the customer. We have this software where you can put in the address and things like that, and it kind of like points you to the right direction for the right policy for the homeowner, based on price and other underwriting factors. I've been in the business for 20 years. Before this, I worked for AAA, and before that, I actually worked for Allstate. So yeah.
Excellent. Well, thank you so much for the intro. And yes, especially with that kind of experience coming from a bigger carrier to being a broker, I want the audience to be able to understand about the difference and the solutions that are out there. So before we talk about what's happening now, I would love for one of you to share, how did we get into this position? Like, what is the history of now a lot of the big carriers are not even able to write or not writing. So can one of you just share a little bit of the history, like how long has this been and how do we get to this position today?
Whichever one's over.
Yeah, one of you just share.
So I mean, from my experience, we've never really had these crazy wildfires in California, in the past. I don't remember the skies turning orange, year after year after year. And in the last 6 years, we've had the sky turned orange like 4 times, at least four different years with the skies orange. You got ashes on your car. And basically in the insurance industry world, California, not just Farmers, not just Allstate, not just any specific carriers, but the insurance industry as a whole, the wildfires wiped out roughly about 25 years worth of profit in 5 years. So that caused everyone to basically slam on their brakes and say, hey, like, wait, we need to figure out what's going on because we don't want to go bankrupt. And so carriers started basically looking deeper into it, either stop basically not writing any more new policies and putting a pause on it, or leaving California completely.
Anything for you to add, Richard?
I mean, I think part of it too is that proposition that was passed back in like 1988 or 89, where it really just hampered insurance companies from raising rates, and it was like almost too much regulation for them. Just like any other business, when you're losing money, you have to raise your rates. And in the state of California, especially in the admitted market, you do have to file with the state of California for a rate increase. And back in the day, that was like, even if you filed for a rate increase, they might not even give it to you. So I think it was like a combination of depressed premiums because of the regulation, and then global warming in the last 5 to 10 years, where we've really been seeing increases in fires and other hazardous conditions that are just leading to companies not being profitable.
And so related to that proposition, and basically in a sense, that proposition has some sort of basically cap as to how much premiums can increase each year. Is there any sort of sunsetting on that at all? Like, do you see any sort of political will, or is the government in for California just wanted to say, look, we want to quote unquote protect that carriers don't just jack up rates by 2, 3x? Like, what's happening on that front? Because it's been some time now.
Um, I, I'm not an expert on that, but I do believe they are figuring out ways to get around that 6% that they can increase. I know that a lot of carriers this year alone have increased their rates by, 20-30% sometimes. So I think they're reacting to it. I think there's a political will to change it. But it's slow. It's government. That's how it works. It doesn't change overnight, but yeah, I think it's going in the right direction overall.
I believe they're also working on trying to speed up rate approvals too, because it takes when you do a rate filing, it's like 6 to 8 months before you even get before you get an answer, a response. So now if they're allowed, now they're trying to speed up. Hey, let's give them like a 30 to 90 day, like let's just speed this up so that we can, if they need a rate increase and it's justified, let's give it to them in the 30, 90 days. Let's not wait for 6 months before we can give them an answer, right? Because 6 months, a lot of things can change, right?
Yeah, 100%. So, are given the changes that have occurred, are there certain areas that are impacted more than others, or can insurance providers not be able to discriminate who they can give coverage?
It's definitely completely changed in the last 2 years. Like if you have a house that's on the edge of town next to a field, I'm seeing, carriers decline it because of wildfire risks, things like that. Before it would have been fine. So yeah, they're getting more stringent. They're getting more stringent on things like bushes around your house, trees, um, electrical, roofs, things like that.
Yeah.
Yeah, I mean that's interesting because I know like even at one of my nearby one of my listings and even in Dublin, and you would not think Dublin was anything like we're not talking about things in like Lake Tahoe or something like this in the middle of forests. I mean, we're talking about a pretty dense area that yes, there are regions that don't have as much people around or buildings around, but they just have like more open fields. And this is what I'm referring to of like west part of Dublin. When we try to get insurance quotes, like there were very, very few options. And there's a lot of homes there. And these homes are 2 to $2.8 million homes that are really, really nice homes. And they were just built in the last 10 years there. And so this is not even a random cabin in like the hills of Los Gatos or something that's super hard to get to. This is literally 5 minutes drive to a Safeway. And yet, for whatever reason, like even something like this doesn't have the ability. Now, walk me through something like I still don't understand related to how insurance providers are determining the level of risk, whether they're going to insure or not. So, for example, I'll use the same example on the natural hazard disclosure and on the disclosure reports. It is not in the high fire zone at all. Yet, do you guys have something that's completely different in terms of like fire risk or these different profiles that homeowners are ordering in advance to know about an area, whether it's in a high fire zone? Like, do you have some sort of different rating system? And is that public at all, or what do you guys use?
I'm not sure if it's public or not, but we use ISO, and that basically determines what the fire line score is. So a lot of carriers, it goes from 0 to 30. And the fire line scores in California, most carriers won't even touch it after 2. Fire line score 2. Meaning you'll have to get a California Fair Plan where you get a fire policy separate from, we'll cover everything else but fire, and then you get your California Fair Plan that will cover fire and vandalism and whatnot, and wind hail. But yeah, we use ISO, and a lot of carriers, they look at the fire line scores. If it's over, farmers will take up to a 3. For commercial, will take up to a 6. But anything above that, we won't touch. And I want to say, like, for example, Oakland Hills, you're probably looking at like an 11, right? So, and then Santa Cruz is probably something like closer to like 15. So it really depends. Right now, a lot of people have been pushing everything to California Fair Plan, which is also not a very feasible thing to do, because what happens is all the admitted carriers are going to end up having to fork the bill. So, for example, even though Farmers doesn't suffer the loss, when California Fair Plan runs out of money, they're going to say, "Hey, you guys are admitted carriers. You guys need to fork the bill for the difference." So when Farmers has to fork the bill, then we have to raise your rates, and you're like, "Wait, but you guys didn't suffer any losses. Why do we have to pay the bill?" But that's the agreement, so that if we're not able to cover the fire, we push it over to California Fair Plan.
Yeah, Richard, any comments on this? Like, do you have something
Yeah,
else?
on the broker side, like people ask me this all the time, especially real estate agents. And I honestly, sometimes I can't figure out the rhyme or reason. Like there'll be a house that I can insure and it'll be fine. And then like three houses over, I can't insure the house three houses over. And I don't know why or what the rhyme or reason is. I think each carrier is looking for a certain risk, and they have that risk in mind. And if it doesn't fit in their box anymore, they just don't take it. And that's just kind of how it's been going. I don't know, to be honest. It's bizarre.
Interesting. Now, I know you guys mentioned some words, and I don't even know the meaning, but I'm sure the audience has no idea what you're even talking about. What is an admitted plan, and what's the difference of that versus a non-admitted? What does that even mean?
You want to take that, Aaron? You want me to take?
Go ahead.
I mean, basically, an admitted carrier is a carrier that files with the state of California. They follow the state of California regulations. I would say it's a more regulated policy. It also, they have to carry a certain amount of reserves, versus a not admitted carrier. They don't follow the same rules that the state of California lays down. They don't have to carry the same amount of reserves, but they have more flexibility. So they can change their rates at renewal if they want. I always tell people, for example, if you're at a zip code where they lost a bunch of money, they can go and tell all the people in that zip code and raise their rate at their renewal by like, $1,000, and they don't have to file with the state or anything. So there's more flexibility with surplus lines carriers, but generally speaking, they also design the policies to not cover as much. They have limitations, like some of them will only offer 10,000 for water coverage, or they'll have a $10,000 deductible for water coverage, things like that.
Now, if that's the case, is there more risk that, like, how big are those entities in these non-admitted carriers, or if they're not following the guidelines of the state of California, like how likely is the balance sheet to be able to sustain a big incident?
It's carrier to carrier. Some carriers will have a ton of money. Some carriers will not have a lot. And you have this giant wildfire, kind of like in Butte County. Remember when they had that giant fire? There was a couple carriers that got wiped out, that were, basically just wiped out because they didn't have enough money to cover all the losses. So, I mean, that can happen. It's carrier to carrier. You definitely want to do your research. You can go on AM's Best and you can look up every carrier's financial strength and their rating.
Wow. Okay. Yeah. So that's super important, because on one end, people just want, they want insurance. They need insurance to even get a loan to buy a house, to even move forward. At the same time, like a lot of these, especially non-admitted carriers, are not even in. They're definitely not in this. They're most likely not in the state, and they're kind of doing their own thing from what I've seen. And because of what you just shared, like even though it may be a couple $1,000s less a year, you got to hedge the risk yourself and decide, like, are you okay with this plan or not? Right. And like, what's the, how likely is this carrier able to survive any sort of kind of big incident? It's a tricky thing. Um, I want to kind of go over like, I know high level how California Fair Plan, like why it's there, but it almost seems like they're kind of stepping over, like, and just trying to be the dominant now insurance provider. Like, so what's the history of this California plan, and was it ever this big before?
No, California Fair Plan was not made to exist to grow to be a policy. California Fair Plan was a last resort policy, meaning, hey, don't come to us unless you can't get it anywhere else. They created it because basically a lot of carriers were saying, hey, we're not gonna cover this area, we're not gonna cover that area, and basically people couldn't sell homes. People, and if you can't sell homes, then you're not gonna get property taxes. Then people are not gonna be able to pay for the municipality, schools, schools, libraries, and police stations and all that stuff. But then they said, okay, well, how do we get people to insure that area? So the admitted carriers got together and said, hey, how about this? We'll cover this, we'll cover it for everything other than the fire loss, but you cover the fire loss and you kind of create your own entity to cover the as a last resort policy. But what ended up happening with all these wildfires lately, I mean, in the past, that's how everyone used the California Fair Plan. But now, because of all the wildfires and everybody tightened up their belt, everybody's flooding into them. And I believe I saw this video on a news article that said California Fair Plan has $200 million in the bank and $300 billion in exposure.
Wow.
So that is not what they were expecting. They said they basically doubled, tripled, and they don't want that. They don't want that. They want to be a policy for last resort for the people that in the hard to place areas, not people in San Francisco. And I have insured some people in San Francisco for California Fair Plan because they just couldn't find a policy, and they were right next to a hill.
Wow, 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 wow. Yeah, I mean, they're clearly, I mean, on one end, it's a government entity, so it's the state of California. So on one end, the likelihood of it going bankrupt versus like those non-admitted carriers is theoretically less.
They're not
But
going to go bankrupt. What's going to happen is when they run out of money, they're going to ask the admitted carriers to pay for it. And then when
Mhm.
the admitted carriers have to pay for it, then they're going to raise rates. And if they can't raise rates they want, they're going to leave. So you have to have some type sort of checks and balances as well, too.
so it's interesting because the carriers have already left. For a lot of the carriers have already left, but the existing ones are still, some are still renewing and things like that. But there's really a big incident that now the fair plan is now asking for the renewal ones left, and it kind of just makes it a snowball effect worse.
Yeah.
Because now you as in farmers or these insurance providers may be like, I'm not even going to renew people now. And then there more people obviously have no choice, but then go to the fair plan, and that just gets accelerated. It just
Yeah.
increases. So it's just a terrible cycle.
Yeah. And if the farmers leaves California, or if any large admitted carriers leave California, then now you have a smaller pool of people that's going to pay for that California Fair Plan when they run out of money. So then those carriers are going to be like, whoa, 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 and then they're going to want to leave too. So yeah, they got to find a way to fix this.
Yeah, no, that's really, really bad and really messy.
Not building in high fire risk areas. That's a good idea.
100%.
I mean, that's probably one of the, or have the government work on trimming back all the trees, burying all the PG&E lines. That's going to be helpful, but how long is it going to take to get all done?
Yeah, I don't have too much confidence on any of those. And that's kind of part of the tricky thing, right? Like on one end, a lot of the land and a lot of any opportunities for new development tends to be more in the hills, because that hasn't been developed more. It hasn't been really developed before, right? If you think about a lot of the places that even has any space, but maybe they do enough, they remove all the trees and it's all houses, then that removes all the hill risk, if there's nothing left. But no, that's interesting. So, but walk me through exactly how does it get structured? So you have this California Fair Plan that is really was the backup. Now, quite frankly, it's like the primary, especially in higher risk areas. How is it actually wrapped? So how do you as farmers or Richard with Goosehead, like how do you guys actually wrap it all together? So what's what and how much are you kind of how much is it in general for a policy like this?
So basically, the California Fair Plan covers fire, wind, and vandalism. Those are like the three coverages that they cover. And then you purchase a supplemental policy through farmers or whoever to cover water damage, theft, and liability. Those are like the big ones. There's more, but and then when you put the two policies together, it kind of makes like a normal homeowner's policy. The caveat with the fair plan, though, is it's more a la carte. You can kind of pick and choose your coverages. And then there's a 3 million max that you can insure everything for. So if you have a $2 million house with a rebuild of $2 million, it only leaves you $1 million for everything else, which sounds like a lot, but if you add in personal property, other structures, loss of use, debris removal, and all the little other fair rental value, it adds up really quick, And part of the problem is, nowadays it costs $7,000, $6,000 a month to rent a house. So you have to find money if their house burns down, to get them somewhere else. That's where the fair rental value comes in and things like that. Am I missing anything, Aaron?
No, you covered it.
Now, what about the idea of still what about umbrella policies? Are they still able to stack on this, or something's happened with umbrella policies too now?
Umbrella policies are excess liability policies, strictly for liability, not for rebuilding your home. So it has nothing to do with property damage or replacing your home. It's strictly just, hey, if I cause anybody bodily injury or property damage, then I've used up all my liability on my auto or my home, then my umbrella policy will kick in to cover more liability. So think of it like lawsuit insurance.
I see, got it.
Yeah.
And related to your own clients or even people that you talk to, is there any percent that is so as a homeowner? I think it's only if you have your loan paid off, which many people could have their loan paid off. Some can choose to do a self-insurance. Like, how often are you seeing that all, or people are not even considering that? Do you even hear stories like that in the Bay that people are doing self-insurance?
I have some clients that are self-insured because they just couldn't afford it. They were in Orville and High Fire Line, and when they got the quote, they said, you know what, I'm in a fixed income, I'm retired, I just don't have the money, house is paid off, and I'll just roll the dice. And had nothing has happened over the last 30 years, I'm just gonna roll the dice and self-insure, and then hopefully nothing happens. Fortunately, knock on wood, the client that I'm speaking of still has their house.
But the only way to qualify to be eligible to self-insure is the house has to be paid off, right? Like, if it has any sort of loan left, the lender would not there'd be some issues.
Yeah, because technically you don't own the house yet.
Right.
You don't own the house until the house is paid off. So your interest it's still their interest. So they want to make sure their interest is protected, which is why they require that you have insurance. And if you don't get insurance and they find out about it, they can give you something called a forced place insurance, where they will basically charge you an arm and a leg for barely any coverage.
Got it. Okay. One other item related to this, and this may be a separate line item itself, that we talked about, like fire. What about how does flood insurance work? How does that work? Like, let's say there's a flood certificate and then it shows like it's in a flood special zone, and there's different things that say it's required or not. Like, who's the insurance provider of that technically? And those lines change too.
A flood is considered a body of water that goes over two properties. So, like, say, for example, and a property can be a street. So say water flows over a street into your house, that's technically a flood. There's two types of flood carriers. There's the federal program. What's it called?
NFIP with FEMA.
MFIP, yeah, through FEMA. And then there's private flood carriers as well.
Mm-hmm.
Usually the private carriers are on the excess lines side. They're on the surplus line side. But they're actually good options for people. Sometimes they can be a lot less expensive than the federal program. Probably because they have better data and they can evaluate whether it's going to flood better than maybe than the FEMA. I mean the
fire side.
Yeah.
Because they have the the bodies of water. They kind of see sea level rises. They can make their own assessment and assumptions there, right? And especially here, we don't have like hurricanes or anything like that. And maybe in Florida it's different when it comes to the policies there. But here it seems like it's it's not it's not actually that expensive
Yeah.
even to get flood insurance. So they clearly have their numbers pretty analyzed to be able to not charge like what these fire insurance, these fair plans are charging and asking for.
Yeah, we also we don't get extreme weather like Florida and everything like that, or
Sure.
Texas too. We get crazy fires, which is why we have, and we get earthquakes, which is why we have California Earthquake Authority and California Fair Plan. But whereas for them, they're more concerned about like, flooding and stuff like that, so because it doesn't hit us as hard.
Right. So there was this one news video report, I think a couple of months ago, where this person like drained their pool and then now they lost like their insurance, something like crazy like that. And like any idea of what was the real case about that? Like how they may have lost the insurance from something like that?
I heard of that story, but it's funny. I don't know. I didn't look deep into it, but I can tell you, I can see why that could be a hazard and why I would want to cancel the client because now you don't have a pool, and if somebody falls into it, they can crack their skull, and then they could sue you. Like if you have guests over and it's not covered, and there's no water in it, and all of a sudden somebody falls into it, because you guys are having a party or something in the backyard, he falls into it and cracks his skull. Guess what? He's suing you guys, right? So that's almost like having a hole in your front lawn and somebody just tripping over it, your mailman tripping on it.
Yeah.
Yeah, I agree. That's why you don't see like diving boards anymore either. They're
Yeah.
just too dangerous, like it's just too much liability. Too many people have broken their necks over the years or jumped in, hit the bottom and broke their nose and things like that. So they just don't want to deal with it.
Same with trampolines. They don't like trampolines either.
Yeah.
Yeah.
But the
Wow.
trampolines have gotten better since we were
Yeah.
kids. I don't
Yeah,
know
they,
about
they
you.
got those
Now,
nets
now you can net them. That's why.
Yeah, you got the nets now.
Yeah.
Yeah.
You either do that or you go to those indoor bounty house ones.
Yep.
You got those
Yeah,
giant
exactly.
facilities now, right? Now, we talked about a lot of the things that have been going on as a macro. Now, as a homeowner, as an individual homeowner, is there anything that they can do themselves for their own place that can reduce risk and or improve their policy? That's not like just installing fire sprinklers into your place. Like, is there anything that they can actually do to just even get a better rate?
Yeah, one of the things I noticed a lot of clients do is they treat insurance policies like a maintenance policy, which is not. They treat it like a home warranty policy. Oh, my water heater is not working. It's leaking. Can I get a new one? Or hey, my roof is starting to get old, but you know what? I'll just wait until something happens and then I'll file a claim. But half the time, or 90% of the time, we don't cover wear and tear. We don't cover maintenance. And however, whenever you file a claim, we got to send someone out there. The overhead cost, the net cost in terms of sending someone out there and denying your claim still costs us roughly about close to $2,000 on average per claim. So imagine if I only charge you $2,000 a year and you filed one claim, then that's a wash. We didn't make any money off of you, right? Even though we didn't cover your claim. So the insurance carriers are now trying to make sure that a lot of carriers are starting to increase their deductibles. And like farmers, if your home's insured for $1 million or more, we require that you have a 2% deductible, 20,000. By having that $20,000 deductible, you're not going to let your home go to, basically fall apart. You're going to make sure that your roof is up to date. You're going to make sure your paint is, you're not going to get wood rot. You're going to make sure that you maintain your home properly and not just file all these little, willy-nilly claims that basically eat up our profit, right? Even though it's not covered. So like, that's my biggest tip for homeowners. Make sure you maintain your home properly. Because carriers are, they're not, and if you file too many claims and you have $0 claims, too many of those, there's carriers that will non-renew you too, including farmers. Because you're basically, hey, it's eating into the profit and you're just a paid claim waiting to happen. So therefore you're just high risk versus the guy next to you that never files any claim.
Right. But is there anything that a homeowner can do, like any sort of improvements though? So like,
Update
is
your
there
roof.
anything they can spend money on to lower their premiums is what I'm referring to.
Oh, okay. Update.
Like, is there anything they can do?
Burglar alarms, fire alarms, whole home water leak detection systems with automatic shutoff valves, newer roofs. Some carriers give discounts for newer roofs.
Like, but just general numbers for something like that. Is there even much of a return on doing that? Because that's the question too, right? Like they'll spend, if they get a new roof as an example, that'll cost like 15, 20 grand.
and you might
Well,
save like $100, $200. It's not a lot. It's not a lot, but
so there's nothing really that makes any
yeah.
cost-effective sense.
It's not necessarily about cost effective. It's if everybody's on board doing the same thing and making sure that, hey, we're taking care of our home, and then all of a sudden you have these carriers that are basically profiting. If I'm making $100 off you and I'm only paying out $50, why not just lower it to $75? And then you're gonna have more carriers coming back competing. And when they compete, competition creates lower rates.
Right.
And so that's what needs to happen. Everyone has to be on board and making sure they protect their homes. And basically, once the carriers feel that, oh wow, I'm actually becoming profitable because everybody's taking care of their own homes, then carriers are going to start coming back and carriers are going to start competing, say, hey, you know what? I'll give you a better rate. I'll give you a better rate. And that's going to open up the market a lot better rather than, hey, let's let my home go in shambles and then file a claim, file a claim, file a claim, file a claim, and then they pay out $115 for every $100 they collect. And if that happens and that happens over time, that's what's happening for the last 6 years, that every quarter we've been losing money at farmers. So that will create farmers to basically say, hey, let's put a stop on this. Maybe we're losing too much money.
Yeah, I'm not seeing like a lot of things that you can do to save money on your homeowner's insurance. I'm seeing things that you can do to preserve your homeowner's insurance from getting canceled. I've seen carriers ask that you cut trees back, um,
Hmm.
bushes near the house. Those are like things that they don't like anymore, especially right against the house, because they've done studies where even though they're like fully healthy bushes and watered all the time, they'll still burn in a really hot fire, and it helps like start fires when you have brush and things like that near your home. Um, New roofs, you will get a credit, but you're not gonna get your money back. Same with burglar alarms. Yeah, if you're gonna get one anyways, that's great. You'll get a discount, but the savings isn't there because you have to buy the burglar alarm, right? But those are all things that preserve your insurance. But I don't know, there's not a lot you can do just to like reduce your rates that much on a cost analysis, because it always costs more to reduce the rate with the things that they ask you to do, if
Yeah.
that makes sense.
No, yeah, 100%.
But also,
Related to insurance dollar amount and policies, is there much? I know most of it at the end of the day will be relative to like the replacement value of a home. Now, in certain areas, like let's just say Palo Alto as an example versus a place like San Jose, right? For Palo Alto, because the price per square foot in the area is significantly higher, you'd be looking at like a $3.5–4 million place between, let's say, 1,500 to 2,000 square feet. Versus in San Jose, it's I mean, for anywhere close to that, it'll be a mega mansion. It'll be like 4,000 plus square foot home. But at the end of the day, it's still a price per square foot on the construction side of it. That's like what it boils down to. It's not really half just because you're in San Jose versus Palo Alto. So as an insurance provider, is the rate has any is there any quotes on that relative to the value of a home at all? Or is only just like how big it is and how much it costs to replace? So for example, if a home in Palo Alto costs 2x, is their insurance provider 2x or is it 2x? Then something in San Jose?
no, it's based on loss ratio. So you could easily have a home insured for $2 million, and then San Jose, if let's just say the loss ratio is the same, even though the house in Palo Alto might be worth 4 million, and let's just say the house in San Jose is worth 2 million, but you're insured for 2 million each, right? But the loss ratios are exactly the same. You're probably going to have the same rate more or less because they don't care about the market value. Market value includes the value of the land, what it's worth to you, and we don't insure dirt.
Yeah, no, that's really interesting. No, I mean, that's really interesting. And that's what I kind of always found interesting on like the cost of ownership of a place that's very central. Like the value of the home is one generally significantly higher than something that's like kind of in the middle of the hills or nowhere. Yet that the other one is significantly more expensive. But it's a very tricky thing that insurance providers and also those homeowners have to deal with, especially those that have lived in the place for a long time. And on one end, you feel very sympathetic to them because a lot, like most people, their home is their entire net worth. And 10 years ago, when they lived in those areas, there wasn't this kind of issue. right? But now you can't even insure it, or the insurance is super expensive. So people like you just brought up have to self-insure. But at the same time, those are the highest risk for an insurance provider to pay out, right? And from a renewal policy, I just want to confirm, like from an insurance perspective, they can technically be like, look, I don't want to insure anybody in Lake Tahoe ever again. Can they do that technically?
Yeah, I mean they're doing it right now.
So they,
Or
okay.
they're pulling out, or they're grandfathering, you know. They're just saying we're not writing new business, but we'll keep the business that we have already until they move or, you know, die or whatever. Um, but yeah, I mean, yeah, going back to the rebuild, you know, that like he said, we only insure the house itself. I've seen houses like out in the middle of nowhere where it costs more to rebuild it than what they bought it for.
Yeah.
Just because the construction costs and things like that. And you know, when you get to remote areas too, it's more expensive because you have to truck everything in and bring the workers in and things. So
100%. Yeah, 100%. Well, no, I mean, I appreciate all this information. I think the audience and a lot of people that are tuning in will find this tremendously helpful. For those that are tuning in live, if there's any questions, feel free to leave it in the comments, and we'll address it as we wrap up. But I want to like finish off with a little bit of a future outlook, because this is not new, right? This has been playing out for a while now, and but I'd love to hear from both of you. What do you is there anything? Do you think anything or much will change over the next year? Is there anything? Is there any of this that's actually political that can help or hurt how this has been, right? Like maybe after the election, does that do anything with these changes? Because you look at what Gavin Newsom's doing. Now all of a sudden he's like, let's go clean up all of our streets and let's just remove all these homeless shelters. Like, dude, this has been the case for 3 4 years, right? Like now all of a sudden you're the one that's taking photos with you picking up trash from them. Like, is there any of this that's political that could help like can ultimately help?
I think actually, I think California is going to figure it out. I mean, it's too big, right? And companies want to do business in California. There's 40 million people here. So there's a lot of money to be made. I think that it's going to change. I think you're going to actually, I think the big companies are going to start their own excess and surplus lines carriers. So they have the more flexibility. Unless the political environment changes and they give them more flexibility. But I've already seen that with a couple of carriers now, like Bamboo. They have an excess and surplus lines carrier. When they're at capacity, they go, oh well, we can't write anymore in the zip code with our admitted carrier, but you can do this excess and surplus lines carrier. So I think the outlook's going to be overall. I think it's going to be fine. We just got to figure it out. That's all.
Yeah, California is pretty like this. California is the largest state in terms of insurance out of all 50 states. So they bring in the most money. So I don't see them letting it fail. It's too big to fail. Is like I agree with Richard. What I do see them doing though in the future is I can see a lot of carriers kind of following suit to what Texas is doing, basically having a 1% deductible for everybody. I think when they see, hey, we're putting the responsibilities on the insured and they're maintaining their homes better. We're having, they're not filing because they know they have a $20,000 deductible. They may not call me to file a claim for their fence blowing down, which might be, they know it's less than 20 grand, right? And then we have to send someone out there and spend $2,000 or $1,000 just to write them a decline letter, right? So a lot of them, I think a lot of carriers are going to start following suit and increasing deductibles is what's going to start happening. And when that happens, they're going to have less claims, more profit, and be able to bring more carriers back. And people will just follow suit, saying, "Hey, you know what? Whatever carriers Richard's using looks like it works. Then let's follow what they're doing if they're profitable."
How were those deductible percentages determined before? Was it a market thing, or was it a state had some sort of mandate that you couldn't charge a certain amount?
It's
right.
Whatever the carriers wanted to do. So they have as low as $500 deductibles, $250 deductibles. But you can get up to 5% deductibles. And and the deductibles, when I talk about percentage, we're talking specifically based on the dwelling amount. So if your home is insured for $1 million, then that's 2% will be 20,000. If you're insured for 2 million, then that'd be $40,000. So it's a percentage of the dwelling amount is what we're using.
Got it. Okay, excellent. Well, I want to conclude here, but before we head off, Aaron and Richard, thank you so much for your time. If you want to please share, like, what is the best way for them to talk to you? I'm sure different people may reach out to you, but I will also have your contact details in the description on the YouTube channel. But why don't you share, Aaron, first? What are the best ways for people to just get a hold of you if they want to talk about, if they are already thinking about policies or wanting to potentially buy a place? What's the best way to contact you?
Yeah, best way to contact me is just call my office. You can email me as well too, and visit our Yelp page that has all our contact information on there. And yeah, we can help you that way in terms of determining what type of policies you guys need, determining what type of coverages you guys need to be properly insured. And if we don't have the product for you, or if I don't have access to that carrier, I'll refer you over to Richard, because I work with Richard as well too. He's a great guy.
Cool. And then Richard, how about you? Like, what are the best ways for people to talk to you and explore options?
Yeah, I always like an email. I like a phone call too. Usually the phone call is the best way because there's a lot of discovery that I have to get through just to find out what's going on. But an email, just an introductory email works as well. And then I work with Aaron as well. And when something doesn't fit for me, I give it over to Aaron and so on and so forth. So.
Yeah, and that's why I had both of them on, because they at the end of the day, if they can certainly help you, they will. They have a lot of different providers and tools out there. But like anything, just like myself or the lenders that I work with, like there's different programs for each depending on the specific situation. And especially right now, you just gotta, especially if you're a homeowner, if you're an existing homeowner, this is the reality of what it is. You got to be more flexible, otherwise you're going to be very limited at buying any home. Number one, and not getting any policies, right? And so it is what it is. These guys will be on top of things as things change, so they'll be a great resource for everybody. But appreciate everybody for tuning in. Appreciate for you guys for joining, and